First of all, whenever we read an annual report, there are certain principal questions which we seek answer. First and foremost question, is the company making money or losing money? Means, are the operations of the company positive or negative? If positive, how much is the sustainable cash flow? Second question, what is the capital efficiency of operations? Are the operations of the company working capital efficient? Fixed asset turnover, fixed asset wise efficient? Means, is the capital which is deployed in the company, is it judicially used to achieve a maximum rate of return on the capital, or is it not judicially or efficiently used? Third question, does the company exhibit ability to pass on cost escalation to its customer, whether it is material cost or whether it is other cost? Is the company having adequate liquidity to sustain any shocks in the near term or the medium term? Most importantly, relevant from a banking perspective and from an investor's perspective, most importantly, is the company regulatorily compliant? Two ways in which investors operate. One is a fundamental analysis, one is a technical analysis. The primary assumption of fundamental analysis is performance drives wealth. So when we say performance drives wealth, we have to analyze performance, and that analysis of performance, the primary document is the annual report. Technical analysis is more to do with chart reading. It is also referred to as charting through that matter. Principal assumptions of technical analysis being that all the information in the market is of the company is discounted in the market price. Price moves in trends and history repeats itself. So from a technical analysis perspective, analyzing annual reports may not be as relevant, but from a fundamental analysis perspective, it is the holy grail of fundamental analysis. Now let us dwell into each of these principal questions. First, is the company making money or losing money? Are the operations of the company cash positive or cash negative? Cash flow is at the first point. So we first read the cash flow, suggested reading. How much is the sustainable cash flow? So cash flow is a combination of the cash profit and the working capital changes and the capital expenditure, beginning with cash from operation at the beginning, cash flow during the year, and cash flow at the end of the period. Now, to know how much is the sustainable profitability, the next thing is to look at the P&L and to understand the business of the company and remove any extraordinary items, or segmental result is mandated by an accounting standard which says that the company is to report segmental results based on the segments which has been devised for reporting. The segments can be geographical so far as a business segment is concerned. So all the separate business verticals would be also independent business verticals or business segments. Looking at the profit or loss statement vis-a-vis the segmental result and having an understanding of the overall business of the company would help in understanding and answering the question as to how much is the sustainable cash flow. What is the capital efficiency of operations? What is the amount of working capital which a company requires for every 1 unit of incremental sales? What is the incremental working capital which a company requires for every 1 rupee of incremental sales? That is what we mean by working capital efficiency. The cash flow statement in the indirect format starts with cash profit or EBITDA or for PAT for that matter, and then interest is added back. Then we have working capital changes. So if you compare the working capital changes or the delta working capital which is reported in the cash flow statement to the delta revenue which can be inferred from the profit or loss statement, then we can know as to what is the incremental working capital efficiency of the operations of the company. Fixed asset turnover. How much is the investment in fixed assets the company is required to make to deliver its turnover? The incremental fixed asset addition would be reported in the cash flow statement, and by looking at the incremental turnover which the company has achieved, some broad sense can be done, especially by doing a time series analysis as to what is the fixed asset intensity or the capital intensity of the operations of the company. Does the company exhibit an ability to pass on cost escalation to the customers? It is the ability of the company to maintain its margins. So if a company has had a raw material cost escalation and it is able to pass on that raw material cost escalation to the customers, albeit with a lead or albeit with a lag, because there may be rate contracts which may need to be renegotiated. This is particularly true in case of B2B businesses, and in B2C businesses, this ability to pass on cost escalation to the customer is more pronounced as compared to B2B businesses. So if you compare the operating margins of the company across multiple years, especially on a time series basis, then that may be an indicative of the ability of the company to pass on cost escalations. On an individual item level also, material cost, employee cost, other direct costs can be compared year on year to check whether the company has been able to pass on cost to the customer or not. When we say a company has a high pricing power, what do we mean by that? We primarily mean that the company has an ability to pass on cost escalation to its customer and thereby maintaining pricing power. Is the company having adequate liquidity to sustain any shocks in the near term? The company needs to be able to have the resources or the wherewithal to sustain short-term temporary stocks, because there is no long-term without short-term. Each company primarily has to sustain the short-term and the long-term for it to be long-term value additive. Adequate flow of liquidity. And what will help the company survive in the short term? Finally, is the company regulatorily compliant? As part of the company's auditor's report, there is a clause which says that is the company regularly in depositing its undisputed statutory dues. Whether the company has paid GST on all the turnover which it has reported, paid the full amount of income tax in a fair and just manner, the tax authorities will be relying on the annual report to check the credentials of the company. Whether the company has any cases of unattended investor complaints, there is now a mandatory reporting of a table of the number of investor complaints received during the year and the number which has been addressed, the numbers which are pending. So that is also a compliance which companies are reporting. These are the principal questions which any reader of the annual report seeks to answer.